A major component of the loan application process is the credit report and credit score. So let's spend some time talking about credit, credit scores, and how that score is used by your lender. So what exactly is a credit score? A credit score is the result of mathematical formulas that use the information in your credit report to calculate a value between 300 and 850. This number indicates to lenders your capacity to repay a loan. A lender will use your credit score to estimate how likely you are to repay your mortgage on time. It's a tool for the lender to determine how risky it is for them to lend to you. Here are some quick facts about credit reports and credit scores. There are 3 credit reporting bureaus: Experian, Equifax, and TransUnion. Each bureau will use their own calculation and report their own score. Credit scores range from 300 to 850. When you are applying for a mortgage, the lender will pull a score from all 3 bureaus and will use the middle score for the loan application. For the best interest rates, a credit score of at least 740 is required. A credit report is valid for 120 days. If your loan process takes longer than this, a new report will need to be pulled and reviewed. If there are any disputes on your credit report, they must be resolved in order to proceed with the mortgage. The reason for this is that if an account is in dispute, the report does not reflect the payment history, which could then impact your score. An inquiry will show up on your credit report if someone pulled your credit report during the past 90 days. For example, if you are shopping around lenders for a mortgage and each lender pulls a credit report, each pull will show up as an inquiry. You may be required to explain any inquiries to your lender because the lender will want to know if any new credit was extended as a result of that inquiry. It's also important to remember not to make any significant purchases or take out any additional credit between the time you apply for a mortgage and the time you close. Your lender will likely pull your credit again right before closing to verify that nothing has changed from the time of your original application. Even if you did take out more debt and it's not reported yet to the bureaus, it will still show up as an inquiry, and in that case, you will have some explaining to do. If any new debt was extended, this could impact your ability to qualify for the loan. Everyone is entitled to one free copy of their credit report every 12 months from each of the 3 credit reporting companies. You can request this online at annualcreditreport.com. It's a good idea to check your own credit report to verify your information is correct. It's also a good way to detect signs of identity theft. A common question people ask is, how is my credit score calculated? Unfortunately, there is no black and white formula to share on how your credit score is calculated. However, here is some general information about what goes into it. You can see here that your payment history is a large factor. Are you making at least the minimum payment on time each month? The amount you owe is also a large factor. How much total debt do you have outstanding? Length of credit history is also important because this indicates you have experience managing credit and debt. And then the types of credit as well as new credit inquiries are also factored into your score calculation. Let's review some frequently asked questions about credit. Do credit report inquiries lower your scores? There are 2 different types of inquiries, a hard inquiry and a soft inquiry. A hard inquiry occurs after you have applied for a credit card or loan and the potential lender pulls your credit report. A hard inquiry does impact your credit score. A soft inquiry happens when someone does a background check, for example, or if you're reviewing your own credit history. A soft inquiry does not impact your credit score. What if a borrower is shopping for a mortgage loan and has applied to several lenders? Will these inquiries lower my score? Yes, these are hard inquiries and will impact your score. However, Inquiries from multiple mortgage companies during a 45-day window will only count once because the bureaus understand that you're likely shopping around. Will checking my credit hurt my credit score? If you're reviewing your own credit, it's a soft inquiry and will not hurt your credit score. It's actually a really good idea to monitor your own credit. Regularly checking your credit report is a good way to check that your information is correct and can also be a good way to detect signs of identity theft. How long does negative credit stay on a credit report? Negative credit stays on your credit report for 7 years if it's for foreclosure or collections, and 10 years for a bankruptcy. Will paying off a credit card balance affect my credit score? Yes, your score may increase if you pay off debt because this lowers your credit utilization rate. Should I close a credit card? This is actually not advised, as this decreases your available credit. How do I obtain a copy of my credit report? As mentioned, it's a good idea to monitor your own credit report. You're entitled to one free copy of your credit report every 12 months from each of the 3 credit reporting companies. You can request this online at annualcreditreport.com. You may be wondering what you can do to improve your own credit rating. There are many resources and organizations available to provide assistance and guidance on what steps and actions you can take to improve your credit. Some of these resources are listed here. If you would like to know if you qualify for mortgage financing, Sirva Mortgage can help. Visit our website or call our toll-free number to speak with one of our mortgage consultants today.